Welcome back to New Money. This evening we're discussing investments. My guest is Henry Biddlecombe. If you'd like to email me, you can send your inquiry to info@anchorcapital.co.za. Just let me share with our viewers how I pick the emails. I get so many emails during the course of the month. I try and batch those emails in terms of those that I think are very of a similar nature. Some of them really don't fall into this particular program. They may fall into financial planning or estate planning. That's our deal. But I've got one from George in Madden. He says, with interest rates likely to drop during this year, how do you view being invested in government bonds? With the bond market.
Yes, I think bonds as an asset class right now look interesting. Long term, I expect rates to come down. And on that basis, I expect bonds to appreciate. But if you're asking me for a trading view, so on a timeline, on a sort of 6-month timeline, I'd stand back and I'd buy shorter duration instruments. So right now, I like the money market. I think you're earning a very healthy yield. In the US, you're earning close to 5%, and in South Africa, you're earning close to 10. So I don't think you necessarily need to go and take the risk in long duration instruments like 10 or 20-year bonds. But in the event that those yields do spike at any point in the next 6 months, then perhaps you can rotate out of your money market fund into a higher duration bond fund.
Because both bonds and money market funds are taxable. So you're not getting the advantage there. Then Jack in Durban says, how does inflation differ between countries and the impact on this on the markets? So we've got inflation here in South Africa at 5-6%. You've got inflation coming down below 4% in the USA and other parts. How does it differ, Henry?
Yeah, I mean, it's a long conversation as to why that's the case. I think the important point to make is that there's a significant absolute inflation differential, and that's what drives the depreciation or the appreciation of one currency against another. I don't think investors should worry too much about it. At the end of the day, inflation is something you want. That's what drives earnings growth, and that's what drives investment. And investment, of course, drives economic growth. So what you don't want is to have no inflation, and you don't want too much inflation. And that's what reserve banks spend all of their time trying to avoid. But don't think of it as a negative thing. A moderate level of inflation is a good thing. And I don't really think that should factor into your investment decisions either way, Bryan. I mean, what do you think?
Yeah, no, I agree with that, Henry. But the one thing I also find difficulty, are we going to keep interest rates at this level until USA interest rates start falling? Or could we adjust do we have to?
We have to. And if you've listened to for example, Kuben Naidu always explained it quite well, the Deputy Governor of the Reserve Bank, I found. And that is the inflationary impact of a weaker currency is far greater than the negative impact of a higher interest rate. And on that basis, they are compelled to defend our currency against depreciation. So when the US Fed hikes, we must track them more or less to make sure that the bottom doesn't fall out of the currency.
So, Henry, let's just talk about the election. I mean, is the rand at the moment, other than funds leaving South Africa, selling out of our equity markets and our bond markets, what else is impacting strongly on our rand? Load shedding? What else?
Yeah, sure. So, this is a question that we get asked by our clients often. Yes, there's an element, there are domestic factors influencing the strength or the relative strength of the rand. But the overarching kind of force driving our currency has nothing to do with South Africa, really. It's global liquidity and the direction of money. And right now that flow is out of emerging markets into the developed markets, such as the US. And that has everything to do with the point in the global economic cycle that we're at. And that cycle will turn. When the US cuts, when the carry trade reverses, so in other words, when the interest rates in South Africa are more attractive on a relative basis, you will see inflows again and you will see rand strength again.
So, Henry, the question that we get asked all the time, and you on the corporate, trading side and the equity side, me on the financial planning side, is should I be taking money out at this level? Or should I be waiting, bearing in mind that if you take money out of South Africa, I've always made the point, is you need to invest that money. It's not, don't sit in cash, because if you're going to sit in cash, rather sit in cash here, and then you're going to get the benefit of the high interest rates. But the concern really is, how would you answer that question when people ask you, do I take money out now?
So I'll give you a view, Brian, and I'll tell you what I'm doing for my clients at the moment. We're sitting in rands, and we're earning 10%, and we're waiting for the rand to strengthen, because that's my baseline view. I think parity with the dollar sits at around 17, and until we get closer to that level, I'm very happy to sit in rands.
Okay, then let me go back to emails. Rosalind in Westcliff says, please could you explain some terminology? I will use Wells Fargo as an example. Revenue declined by 11.1%. Diluted earnings rose to $4.83 compared to $3.27. Which number is good and which number is bad? And what do you read into these types of numbers? So she was just using Wells Fargo as an example, Henry. Diluted earnings fell.
Looking at the banks are maybe a particularly good example here, where what's happening on the top line can be very different to what's happening on the bottom line, especially when it comes to things like non-cash charges and revaluations. So there are many levels between the revenue line and the net profit line. So sometimes revenue can go down while profits go up. Margins can improve, provisions can improve, you can release provisions. But really what's important is what those numbers look like relative to what the market was expecting. If they're better than expected, then the price action is good, and vice versa. But again, this is the game we play at the trading screen, at the trading desk. I think what viewers really need to worry about is making sure that they're invested in companies that grow their revenues, because through time, those are the stocks that outperform.
So that example in Wells Fargo, where the revenue dropped and earnings increased, there could be a whole lot of, as you say, there could be a whole lot of impairments that brought back into profit line. So you as an analyst, would you be looking at revenue line more than the earnings line?
So, if I showed you the data, you would see that over a 1-year time frame, things like revenue, profit forecasts, relative profit performance, and short-term kind of earnings movements and PE ratios have a reasonable influence on the price of a stock. But if you look at the empirical data over a long period of time, being sort of, 7 to 10 years, you'll find that all of those factors have a minute impact on the price of a stock. And about 70% of the change in the price of a stock comes from that is determined by, it's a function of that business's revenue growth.
Well, let's go back to Louise in Belita. She says, the US economy is near full employment, which creates greater demand for wage increases. Do you feel that inflation will come down? And is the US economy expecting a recession? I think you've answered that. How severe is the comment that a soft landing is possible? I think you've answered that one. Yvette in Rondebosch says, how do you suggest I go about choosing the right asset manager? I have realized that often the comparisons between the various managers and the performance comes from a team that have now left to set up a new organization. I mean, that's really, past performance is no guidance to future. And often the teams that gave you that good performance have now moved on. Henry, how would you assess that?
It's a great question, and I think the right approach for just about anyone is not to put all of your eggs in one basket. Give some money to a number of different asset managers and monitor the relative performance. And the guys who continually outperform, allocate more to them. And the guys who continually underperform, maybe consider firing them or lessening your allocation to them. Understand that different asset management houses have different styles. Different styles will perform differently at different points in the cycle. It's also good to have a balance between active and passive strategies. But I guess the most important thing is don't put all of your eggs in one basket. Spread it between multiple different active managers and have a passive allocation as well.
Yeah. Eugene in Hillcrest, this is the most important question that is so difficult for us to answer. He says, I find that investing is emotionally taxing, even though I'm a long-term investor. When I see the volatility in the value of my portfolio, I cannot say it does not affect me. What would you suggest how to deal with this? Henry, this is so different. When you buy property, you know it's long-term, you think long-term, and often if it's an investment in a company, you value it at book value and purchase price. But when it comes to equity, so I'll give you an example, which I've used before. You put R1 million into the market, into a property, you sell it for 4 million, you've made 3 million. You put R1 million into the market, it goes to 5 million, and eventually you sell it at 4, You don't say I've made 3 million, you say I've lost 1 million. Then you've asked the question, well, what was the highest price you could ever get on that property? So I'm asking you, how would you handle clients who are emotionally affected by falling equity prices?
Well, what I can tell you is that I'm a fund manager by profession, and I am emotionally impacted by my own portfolio. So it's a very human thing, and it doesn't matter, if you're a retail investor or a fund manager, that doesn't change. Your humanity is there. So the best solution, in my opinion, is to disassociate yourself from that portfolio. And involve a capable intermediary. So a good financial advisor combined with a good set of asset managers, and they will help you to behave in the right way. It's a lot easier to be objective about other people's money than your own. And you'll find that a lot of fund managers have their own personal money with other fund managers for that exact reason. It just stays your hand. So in other words, when markets are performing badly and the human side of you wants to pull back, the advisor or the asset manager will help you to make the right decision and not to make a mistake based on short-term emotion.
That's where you become, you move from being a financial advisor to a financial psychologist. But Moira in Hout Bay says, I understand the pharmaceutical industry has discovered a cure for obesity. Is this not an area that I should be investing in?
I absolutely think so. Whether you're looking at Novo Nordisk or Roche or a number of the other players, I think that's a really, really exciting space. I find it absolutely flabbergasting what's happening in the US. The obesity, the prevalence of obesity there is a pandemic, to say the least. I mean, I think 40% of their population now is clinically obese, and it's heading in the wrong direction. So it's absolutely a huge opportunity for a drug that can help, at least on a symptomatic level, address the crisis. There are 4 or 5 companies there which are well positioned, and I'd buy a basket of them and hold them.
Henry, you've got 20 seconds to answer me one other email about property funds. They seem to have picked up. Are you thinking that should now become an asset class within the portfolio again?
Yeah, we've turned positive on local property counters over the last couple of months. Well, I don't think you can expect huge rental escalations coming through. I think the yield's at a point where it's relatively attractive. And we are seeing a moderate level of sort of escalations coming through the system. In other words, you should expect a little bit of capital growth through time. So if you're looking at a sort of low double-digit compound return over the next few years, I think that's quite attractive.
Well, at the moment, investors are euphoric with the uptick in Bitcoin, the S&P and NASDAQ indexes. The S&P is made up of 500 shares. If you'd invested in 493 of these shares last year and not the Magnificent Seven, you would have virtually no return. All the performance came from those 7 stocks. A warning from an investment guru, namely Warren Buffett. When there's blood in the streets, it's time to invest. And where there's too much euphoria, it's either time to sell or to diversify one's portfolio. Do not be guided by capital gains that you may have to pay. The value of any portfolio is always shown at a gross figure, and there's always capital gains tax that will be paid on sale. Henry, I'd like to thank you for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program, we'll be dealing with financial and retirement planning, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.